We no longer have a capitalist economy the way that we did in the 19th century. Now, to a very considerable extent, the economy is managed by the government. In this lecture, we're going to take a look at some of the policy tools the government uses to manage the economy and see how it uses those tools in order to ensure that the economy grows. In this chart, it shows the gross domestic product of the United States going back to 1951. Now, notice how steadily this line moves up, at least until the crisis of 2007-2008. Well, it's no accident this line has moved up so steadily. The government has been very actively involved in managing the economy at the macro level to ensure that the economy does grow. Now, in stark contrast with the past, the federal government spends roughly 24% of GDP. The central bank creates the money from thin air and manipulates interest rates and asset prices. Credit growth drives economic growth, and the government makes sure that credit does expand. In this chart, you can see total government spending as a percentage of GDP going back to 1930. Well, in 1930 and before, the government only spent something like 3% of GDP. During the Great Depression, government spending increased to 11% of GDP. But in large part, that was because the economy contracted so sharply. The GDP contracted by 46% during the Depression. So this ratio of government spending to GDP really exaggerates the extent to which the government increased its spending. However, when World War II started, government spending surged. Government spending increased almost to 45% of GDP. At that point, the US government took over almost every aspect of the economy: production, distribution, it controlled prices and wages. It was a complete command economy to win the war. And that was successful. But afterwards, it was very difficult to wean the economy off of its dependence on government spending. When the war ended, government spending did go back to 12% of GDP, but only for a very short time. And it was widely feared that the economy would go back into a depression at that point. Then the Korean War started, and the Cold War started, and government spending once again expanded very sharply, going back to 20% of GDP. And as you can see here in this chart, since that time, government spending has averaged roughly 21% of GDP. And with the government spending such a large percentage of the economy, that makes the government the largest single player in the economy. And by increasing the amount it spends, that's allowed the government to ensure that economic growth continues to expand. Next, this chart shows total money in circulation. Well, up until 1968, the Fed, by law, had to maintain gold backing for all of the dollars that it issued, at least 25% gold backing for all of the dollars that it issued. Well, at the end of World War II, the United States had most of the world's gold, so that really wasn't a problem for a long time. But in 1968, they actually came up against that binding constraint. They didn't have enough gold to continue issuing more paper dollars. So they simply changed the law and removed the requirement for the Fed to maintain any gold backing at all. And afterwards, you can see the amount of paper money the Fed has issued has increased by more than $1 trillion, or almost 25 times. Now, there are almost 25 times as many paper dollars in existence now as existed in 1968. And clearly, the ability of the government to create money from thin air gives it extraordinary powers that it would not have had otherwise. And they've used those powers to manage the economy in the past several decades. Now, in this chart, it shows total credit or total debt. Debt and credit are two sides of the same coin. One person's debt is another person's asset. So going back to 1951, up until the present. Now, notice that in 1964, total credit first went through $1 trillion. And since that time, it's expanded from $1 trillion. Well, by 2007, it had expanded 50-fold, from 1 trillion to 50 trillion in just 43 years. Now, this explosion of credit, first of all, it couldn't have occurred if we'd remained on a gold-backed monetary system. But once we removed the gold backing from dollars, that removed all constraints on how much credit could be created. And afterwards, total credit absolutely exploded, growing very sharply and steadily up until 2007 and 8, at which point the private sector couldn't repay its debt. And at that point, when this line began to contract, when credit actually began to contract, that's when the global economic crisis started. Now here, you can see the year-on-year increase in household sector debt going back to 1970. This is the increase each year in the household's level of debt. Now notice in the years running up to the crisis that household sector debt, 2003, 4, 5, 6, 7, 8, for 6 years in a row, the increase in the household sector debt was $1 trillion a year, a $1 trillion increase in household sector debt. Well, of course, that expansion of debt gave the households more money to spend, and that helped drive the economy. And one of the reasons the households had access to so much debt was the state-owned enterprises, the mortgage enterprises, Fannie Mae and Freddie Mac, borrowed the money and lent this money to the household sector. And this fueled economic growth during this period, but then it also led to the crisis immediately afterwards. So we really don't have a capitalist system, as I have said earlier. Under capitalism, the government played very little role in the economy. But now our government's spending 23% of GDP. Under capitalism, gold was money, and the government had very little to do with it. In fact, nothing to do with it. But in our system, the central bank creates the money from thin air and manipulates interest rates. But also, it's very interesting to think of the growth dynamic. It's very different now than it was under capitalism. Under capitalism, economic growth worked like this. Businessmen would invest. Some of them would make a profit. They would save that profit, or in other words, accumulate capital, hence capitalism, and repeat the process. That was the growth dynamic. Saving and investment, saving, investment. That's how capitalism created economic growth. But our economic system really hasn't worked that way now since the 1960s. In our case, our economic system, the growth dynamic, is driven by credit creation and consumption, and more credit creation and more consumption. And that's created very rapid economic growth. In fact, much more rapid economic growth than would have occurred under pure capitalism. The problem is now it looks like this new system, which I call creditism, because it's driven by credit growth rather than capital accumulation. Creditism now seems to be on the verge of breaking down because the private sector can't bear any more debt. It can't repay the debt it has already. So in my earlier course, Capitalism in Crisis, I explained a long series of government policy mistakes that led to the global economic crisis. So if you haven't watched that course already, I recommend that you do. It's available on Udemy. Here's the link. So the economic mismanagement by the government over a period of decades led to the economic crisis of 2008. And that crisis necessitated even more government intervention to prevent a Great Depression. And that government intervention has taken the form of trillion-dollar budget deficits, trillions of dollars of paper money creation, asset price manipulation, and nationalization of the mortgage market. Here you can see the government's budget deficit. Once the crisis started, the budget deficit blew out to an extraordinary $1.4 trillion. And over the last 4 years, the deficit in 4 years has been more than $5 trillion in total. That government spending prevented the economy from collapsing into depression. And to a significant extent, that government spending was financed by paper money created by the Fed. You can see in this chart, it's the Fed's balance sheet. Once the crisis started, the Fed began creating unprecedented amounts of fiat money in a very short period of time. And now the Fed's balance sheet has grown to almost $3.5 trillion. So since the crisis has started, the Fed has created roughly $2.5 trillion from thin air. And they have used that newly created paper money to push up the stock market and the property market, creating a wealth effect by pushing up the net worth of the household sector. And this wealth effect has made the public feel that they can spend more money, and that's boosted consumption and that's boosted economic growth. Here you can see the household net worth. It's now back up to $70 trillion, in fact, an all-time new high, higher than even before the crisis. So the government's policy is designed to prevent the total credit from contracting, because they fear that if credit does begin to contract, there will be a new Great Depression, and they are right to be worried. That is indeed the case. So the government now drives the economy by making sure that the credit supply grows, or that total credit continues to expand. Now, you've seen the blue line before. This is total credit. It's gone up now to $57 trillion. The red line is total credit without government debt. Now notice that without the $5 trillion increase in government debt, the total credit number would have begun to contract, because the private sector actually began to pay down its debt during the crisis. But it wouldn't have flattened out as it has done without the increase in government debt, because without the increase in government debt, all of the banks in the United States would have failed, and that would have destroyed all the savings in the country. And as a result, this red line would have spiraled down and we would have collapsed into a new Great Depression. But because of the increase in government debt, the line moves up with not too much of a dip here. But look what happens when you add in quantitative easing. When you add in quantitative easing, which is represented by the green line is total credit plus quantitative easing. When you add in quantitative easing, the paper money that the Fed has created, there's hardly any dip at all in the economy. There's hardly any dip at all in the total credit growth number. And for that reason, the economy's not collapsed. So it's very important to understand that we have a managed economy. And it's very important to understand how the government manages it in order to anticipate what the government is going to do next. And if it is possible, if you can better anticipate what the government will do next, you will have a much better chance of making wise investment decisions. So this course is going to focus on how the economy really works now, what the government does to manage the economy, so that hopefully at the end of the course, you will be able to anticipate the government's next move and understand how the government's actions will affect asset prices.